Hello guys, welcome back to my channel. Today we are going to discuss about a great financial decision that each and every one of us will have to take, that is whether to buy a house or to rent. So these two are a critical aspect which will impact most of our adult life decision. So whether you live in a city or in a tier 2 or a tier 3 city or a village, you will need a place where you can live and have a shelter over your head. Few of you might be lucky to have a house that has been given down to you by your parents or your elders, which will help you to have a house to live in for free. But most of us have to decide whether to own a house or to rent in a place to live. So there are multiple factors that will affect whether to buy or to rent a house. So in this video we are going to discuss in two categories. One is considering this as a pure financial topic and considering which suits the best, and second, other factors which will impact your decision of buying versus renting. So if this video gets too long, then I might make this into a two-part video, else I will make this into a long video, as the first part itself might span out for 20-25 minutes. Stick on to it and make sure to go check out the Telegram channel where I have shared this Excel file wherein you can play around with the numbers and put in the assumptions and the expectations that you have and the desire and the value of house that you are trying to buy and the down payment, interest rate, rent, etc. And then it automatically builds a very simple financial model, nothing complex, and it gives you the data. Ensure to go check out the Telegram channel Timon EXP. So with that, we'll delve right into the Excel and go through the financial data. So we will start off with this financial model. So over here we are assuming that the house worth that you are trying to buy is worth 50 lakh rupees, as we discussed in the video earlier, and with a down payment of 20%. So this is nothing but the minimum payment that you will have to do in order to get the house, and similarly interest rate will be around 9%, that is the current market rate that is going on, and then the term is nothing but the duration of the loan that you are planning to take. So most people would take a duration of 30 years, and then they might pay down a little earlier. And then the increase in house value, we are estimating that the house value that you are planning to buy will increase by around 10% per annum. Again, for this I will link down few articles as well as put a screenshot over here. And again, similarly, increase in rent we are assuming to be in and around 10% over a period of time. So this is another critical aspect that we have to note, that is the return on investment. So this is the return on investment that you are expecting on the additional amount that you will be investing, and from where this additional amount will it come, we'll discuss it later. So over here we are assuming the return of investment to be in the range of around 12%. That is the return that the index, that is Nifty or Sensex, has generated over a period of 20-30 years. And this rent is auto populated, though you have the option to change it. So this rent is nothing but a calculation of cap rate of around 3%. So what cap rate means is that if you want to live in a house worth 50 lakh rupees, then estimated value estimated annual rent of this house will be around 3% of this house value. So that will be 50 lakhs into 3%. So that is nothing but 1.5 lakh rupees per annum. So when you divide it by 12 months, you will get 12,500, but you still have the liberty to change it. This will vary depending on various assumptions. So now we will delve right into the financial model over here. So when you see over here at 10 lakh rupees worth of down payment and 50 lakh rupees worth of house at an interest rate of 9%, your annual EMI of the monthly payment that you are making will come up to around 3.86 lakh rupees per annum. So over here, because we are assuming a fixed interest rate loan over a period of 30 years, so you will be paying this for 30 years. So don't worry much about these columns because these are auto populated. And over here you can see up until 30th year the EMI has been considered, and after that you will not have any EMI payment for this house. But in case of renting, you started with only 1.5 lakh rupees, and then this investing. So over here the investing that I mentioned earlier is being tied up over here, that is the delta amount or the differential between the annual EMI versus the rent you would have paid. In this case, that is 2.36 lakh rupees. You will be considering it to be invested in index funds like Nifty, Sensex, or mutual fund, or a stock picking that you would have done individually. So in these cases, the 10 lakh rupees that you would have made down payment earlier is assumed to be the value of money that you have with yourself. So similarly, in this case, if you have the 10 lakh rupees worth of money available with you, then you would have invested that as well in the financial markets and assume that you would be receiving 12% on the whole amount. So over here, the magic what happens is, in year one itself, when you would have bought a house worth 50 lakh rupees and then the house value increases by 10%, the house value will go up to 55 lakh rupees. And because your house value over here would have gone up to 55 lakh rupees, your net worth would also have jumped drastically. That is, just on a base of 10 lakh rupees, it would have gone up to 15.28 lakh rupees. And how this is arrived is nothing but, so this is nothing but your house value minus the loan amount at the end of year one. That is, your house would be valued worth 55 lakh rupees, and anyway 10 lakh rupees worth of down payment you would have done, and then 5 lakh rupees is the increase in the house value, plus this 28,000 is nothing but the principal down payment that you would have made against your loan. So similarly, when you see over here, over the period of 30 years, the house value will keep on increasing, as well as your net worth, only with respect to the house. So this financial model does not consider your other external liabilities or assets. So these are only considering the investment decision between buying and renting. So at the end of year 3, your house would have been worth around 9.59 cr, assuming a growth rate of around 10% per annum, but your investments would be worth only 3 cr. So in this case, in this situation, it makes clear sense to buy a house instead of renting it, at least in terms of financial sense. And the other topics, as I mentioned earlier, we'll be discussing it in part 2 of the video. So when you see the renting portion of it, up to until year 10, your rent will be lower than your estimated EMI value, but from year 11 your rent will be higher than the EMI outgo that you will incur. This negative value that is being shown over here is nothing but to match the exact rupee amount or the exact cash flow from your pocket. We are estimating that 2000 rupees in year 11 you would be taking out from your investment that you have made till now, but in case of, let's say, year 15, you'd be taking out 1.83 lakh rupees just to ensure that the net cash outflow from your pocket is still the same, that is 3.86 lakh rupees. But over here, after year 30, you will see that you would have a net worth of 9.5. You will see that in case of renting, your net worth would be only around 3 cr, when you are still extracting money out of the whole investment. Because of that, there will be a drawdown in your net worth. That is up to until year 44. At least you will have some net worth. After that, the whole investment also would have gone down. But magic what happens over here is that, as per few estimates, the increase in house value is only around 8%, and similarly increase in rent is also estimated to be around 8%. So in this case as well, you will see that in such scenario, renting will start making sense. That is, if you are able to earn a return of around 12% per annum by investing the differential delta amount, you are able to be much more better off by renting instead of buying. So it's all about the assumption and the present scenario. So depending on the house worth, the down payment available, then the interest rate, term, and the two major factors that will impact is your estimated increase in your house and rent value, as well as return on investment that you're expecting from the delta or the investments that you're making. That is this column. You're assuming that the increase in house value and rental increase is around 10%, but you're estimating that the return on investment is around 15%. Again, in this case, a situation of renting your house is much better because you are able to generate a lot higher return than actually owning a house. Over here, you can see that if you are making an investment of 15% and still assuming rent and house value to increase by 10%, then just after year 10, you will have to start withdrawing money from your investment to have the same differential amount, that is 3.89 lakh rupees in this case, and you will have to withdraw 2000 rupees in year 11, and in year 20 you will have to withdraw 5 lakh rupees from the investment that you have made, so just to ensure that the total cash outflow from your pocket still remains at around 3.86 lakh rupees. But the magic over here is that because your return of investment on the investments that you have made is lot higher than the estimated increase in house value and house rent, even though you keep on withdrawing the amount, that is after year 30 as well, even if you keep on withdrawing the full amount of the rent required from your investments that you had made, even then you will still be better off in almost each and every year. So for example, at after 40 years of the decision that you took of renting, your net worth would be 27 cr in case you have invested this amount instead of buying a house. But as we go further, the difference becomes quite large. So this has been a financial model which will be helpful for you to take decision making. So few key points over here that I have to highlight, and the assumption that I have made over here is that when you are buying a house, there are few additional costs that will be incurred. So right from the time of buying the house, it will be stamp duty and additional taxes and surcharges that you will have to pay to the government, as well as the brokerage that you will have to pay to the agent. And then additionally, there will be maintenance charge that you will have to incur as a house owner. But in case of renting, you will not have to bear that cost. But in renting, in most situations that you have seen as well as observed, most of them would keep on switching their houses every a few years, say 2 to 3 years. In such cases, they will have to incur additional charge of shifting expenses. But in case of your own house, likelihood or the possibility of shifting is quite low, and that expense will not be taken. So it is assumed that the net comparison between the maintenance charges, taxes, etc. in case of buying a house versus the shifting expense in case of renting will be similar, hence that has been excluded from the calculation. And then the second portion is that there are few places where government has strictly put down rent control. In such cases, even though your property value is being increased by, let's say, 10%, there might be situation where government has put a restriction that you cannot raise your rent by more than 2%, and return on investment is still just 15%. In such cases, buying a house will not make such a financial sense, because over here you can see that your rent will not increase drastically because of the government regulations. Again, there are ifs and ands which you will have to delve much more deeper into. This is a financial model which will help you to take decision. In such cases, you can see that in most situation you're much better off just renting instead of buying, and you will have to ensure that you continue to live in that house. But again, going back to the scenario, let's say house value has been increased by 10% and your return on investment is 15%. Then you see that in such cases, when the differential is quite high, then renting makes much more sense if you are able to generate a return over and above the increase in house value that you are taking. Again, over here there are few aspects which are impacting your decision making, both in terms of financial sense as well as psychological sense and feeling that you have and the experiences that you get, which we'll cover in much more detailed way in part 2 of this video. So ensure to stick around, and for this financial and excel model, ensure to go to telegram channel and join the telegram channel. There you can find the excel file, this financial model attached, so you can download it and play around with it and see in which scenarios or in which cases will the decision of buying house start making sense. And these two are the another key factors wherein it just highlights the total EMI you would have paid in over a course of 30-year period. This is excluding the down payment that you would have already made, and this total rent is for duration of the loan that you were taking. So in this case, after 30 years you need not have to pay any EMI, but you will have to continue paying your rent. But this total rent is nothing but for the duration of your housing. So in case, let's say, you wanted to take it for 40 years, what you have to do is just select this and you will receive a sum of stating you would have paid around 2.5 cr over a course of 40 years, assuming an increase in rent of around 10%, and you will continue to stay in same house or the equivalent house. So this gives you a very nice outlook of in terms of your financial net worth in case you bought a house versus you rented a house. Again, if down payment was increased to 30%, then again it will make a lot of difference, because the initial investment that you made is growing quite a lot in case of investing. Again, if this goes down to 12%, again it changes quite a lot. You can see that your renting is taking away more money from you than yielding you money. Again, if you see a 14% increase, then renting would not be a lot of different, and it will remain close to the value of your buying decision. Again, in case of this renting, let's say you're able to get equivalent house for 10,000 rupees, then again renting would make a lot more sense. Or let's say rent came a complete opposite scenario and you had to end up paying 15,000 rupees for a similar house, then again it will make a lot of difference. So again over here you can consider how it is affecting, and you will have to do a little more research to see which situation is giving and yielding you a higher and better return. So now I'll stop this recording and I'll come back. So the part 1 of the video has become quite long, so I am going to break this video into a 2-part series, wherein this second part of the video will come this Saturday. With this, please like, share, comment down below, as well as subscribe and turn on all the notifications so that you get updated with latest updates and communication from this channel, and help build this community and join the Telegram channel Team on EXP, where a great bunch of people are coming together to build this community. Bye.